Good afternoon, ladies and gentlemen. Welcome to this special episode of Market Guru, where we get you to meet the finest brains of the Lal Street who make a lot of wealth for their clients in bulls and bear markets. And our guest today is Mr. Rakesh Arora. He's the managing partner of Go India Advisors. He's a frequent visitor to our channel and helps small and mid-cap companies create a lot of wealth, not only for their shareholders, but for the broader markets in general. I am Shail Bhatnagar, and with me is Sakshi Batra. This is going to be a very interesting 30 minutes. Rakesh ji, namaskar. Welcome to Market Today, and a very warm welcome to you. Markets are in excellent shape. There is absolutely no cause for complaint, and I am sure you must be refusing more companies than adding them as your clients. Tell us from the lens of a mid-cap and small-cap specialist, how do you see the mood and sentiment on the Lal Street?
So, Shanadi, I'll just give you, an anecdote update about how the market is. So, every year we do a conference of our small and mid-cap companies.
Ji.
This year we had 21 companies presenting. Um, we had 550 registrations from investors to meet them. We had to stop the registrations because we had no space left. Last year, same time, the registration was like 160.
Okay.
So, so that tells you the mood. Meaning everybody today is glued onto the market, and fortunately earnings have kept pace because government has been doing reforms, and there's been a big shift from unorganized to organized, which happened both because of GST and demonetization to some extent, and so that has really helped listed companies give better growth. So valuation wise, we are at the upper end, but not in a bubble zone, I would say, even as of now. So that is a little bit comforting. But otherwise, yeah, markets have been stellar, and we have all been beneficiating from this.
Okay. Rakeshji, what's really interesting is that you mentioned 550 registrations in your event, up from 160. That's roughly a 3.5%. This is a 3.5 times rise. Here are small cap stocks which are going up by 3.5 times in 6 months to a year. That is the point I was probably trying to come at, that this intensity and this consistency of rise in small cap and mid cap valuations and stock prices is a bit worrisome. How are you looking at them?
So there are two parts to it. One is that obviously certain companies were under discovered, and as soon as market gets a hint of what it's in store for these companies, the re-rating is very sharp and ferocious. Meaning people don't really wait for the year or earnings to play out. As soon as they are confident that earnings are going to come through in this company, the re-rating is almost immediate, and that's why we see all these sharp rallies in 1 to 2 months. So those are still okay, I would say, because there's a solid fundamentals behind those kind of rallies. What we need to guard is that there would be stray companies which would be pumping up their profits, and luring investors to push the stock and all that. So those kind of companies we need to really be wary about. So that's why corporate governance, looking at the quality of the management, quality of investors who are invested into the company. So a bit of due diligence has to be done by investors before they jump in.
Okay. Good afternoon, sir. I wanted to also understand from you of the recent run up that we have seen in the markets. How much of the rally is purely based on the retail investors based liquidity, and how much of it is actually based on fundamentals? And where do you see the markets now going forward based on these two parameters, sir?
So, see, I would say we should not underestimate retail investors. We are talking to a lot of retail investors through our platform, goindiastocks.com, and we are in touch with a lot more. And I find that the general understanding is extremely high, meaning they are not anymore, the gullible retail investors of past. These guys have access to the best information, and they are asking questions which are, on par with some of the, institutional analysts kind of, So I would say that retail investors not blind; they're not putting in money, just like that. They have information, and see, large part of the retail inflow is still coming through SIP, which is better way to do it. So I'm not too worried. Meaning this shift was bound to happen. A lot of financial investment savings, which were earlier locked up in FDs or post office savings, is now shifting to mutual fund, which is the right way, I would say.
Okay. So, sir, looking at the upcoming budget now, I wanted to understand from you, are there any key themes, sectors you believe are likely to benefit more from the government's focus? Are you incrementally looking at adding some names from those particular sectors? If yes, could you share some?
So, if you look at the election results and analyze that, that can give us a little bit of clue as to what is bound to happen in terms of government strategies going forward. So clearly, rural economy was not doing that great, and rural economy should come into focus. Already, we are seeing that, for the upcoming elections in Maharashtra, the government is turning, a lot more, I would say, dovish, or they are trying to, play the gallery in terms of giving incentives, rollouts. So I think, the whole opposition plank was based on those kind of strategies, and the new government might pick up some clues. So that could be one of the things which can emerge from this, budget, where, given that fiscal situation is decent, and RBI's big dividend has really helped in that case. Some support might come in for rural India and more money in the hand of consumers, which was not the case for the last two government, where they were focusing largely on infra and manufacturing. I think there could be a balanced approach in this budget. And some of the underperforming sectors like FMCG, etc., might get a chance, to come back to, the lead position.
Fair point. Rakeshji, because you've done a very long stint at Macquarie Capital Securities, where you were the head of research between 2006 and 2016, I'm just trying to dig out the templates that you are looking at this point of time to find out relatively uh, uh, undervalued stocks even in this kind of a roaring bull market. Now, what are you focusing on at a time when the small cap and the mid cap index have given a 1.5x return over the last about 12 odd months? How has your stock picking changed?
So, I mean, there would be a strategy rotation between sectors, between large cap, mid cap, small cap. That is bound to happen. So, we did see, large cap coming back to flavor just around elections. And once things are settling down, mid and small cap are, trying to catch up again. Within the large cap, meaning financials was underperforming for a pretty long time. And it's only now in the last month or so that financials have started to catch up. And within financials, private sector banks were underperforming. They are now catching up over PSUs. So that kind of rotation is already happening. You had pharma, you had the chemical sector, which was underperforming, which is now coming back. IT hasn't still performed as much. Maybe IT will come back. So, rotation will continue to happen. People will shift from, sectors and stocks which have moved up sharply into something which looks undervalued. So, I think, that's the nature of the game. Eventually, what are the bigger themes which will play out is what we need to focus on, and those are the sectors which will give, better returns. So last year, if you see, it was real estate, utilities, infrastructure, which were doing much better. Can this change this year? Maybe yes, with the outlook on the budget that we were discussing. Maybe private banks, maybe consumption, discretionary consumption, maybe FMCG. These are the stocks which could and sectors which can take lead for this year.
Fair point. Private banks, consumption, and possibly IT. and all of them appear reasonably valued compared with the kind of sometimes I don't want to use the word, but reckless price movements that we are seeing in the market over, especially over the last 2 odd months. Rakeshji, the other space that is possibly requesting a comment from your side is this defense counters. I mean, Sakshi and I have this running competition that each day we decide which stock to name which will rise 10%. So there are 5 PSU defense stocks, and by and large eeny meeny miny mo karke we get it right 2 times out of 5.
Today it was DRS.
Yeah. So my point is that what explains this rapid surge in prices, and how much of it is based according to you on pure research, and how much do you think is this very heavy speculative ultra HNI money that is coming in the market?
No, so see, defense is a global theme actually. The dividends of the peace dividends actually wore out, I think, in 2015-16. The peace dividend started when the Cold War between US and Russia was actually, abating, and things were getting much more comfortable, and globally, countries were spending much less on defense. But that changed in 2015-16. And obviously there are these war between Russia, Ukraine, and then we are seeing what's happening in Israel and Hamas. But prior to that, also I think there was some tension brewing in the South China Sea, and the cold. I won't say it's a cold war. It's a kind of similar situation between US and China, because currently the global economies are much more intertwined than what they were when the Cold War was actually happening between Russia and US. So there's tension building up, and defense spends are going up, significantly across the globe. So it's a global phenomena which we are seeing. Number two, the current government has been very vocal about Make in India, and they want to be self-reliant, and they have been pushing, manufacturing sector, not just defense, but all the manufacturing sectors. They want India to be, one of the exporters. Excuse me. And this is supported by China plus one theme for manufacturing. So manufacturing generally is going up, and but India has been one of the largest importers of defense equipment, almost $60 billion worth of imports, and Indian government has been trying to be self-reliant. So I think defense story is just starting. Meaning you think that stocks have moved up, 4 5 times, but they were hardly doing anything for the last 10 15 years, and the order book is only now starting to build up. I mean, in some of the companies, the order book has not even built up as yet. So I think defense theme will continue for a few years, and obviously, like any theme, the returns are going to be front loaded. So maybe after the big spurt, stocks might stabilize despite earnings going up later on. So, but I think we are slightly away from that point. We haven't really peaked out, I would say. I think we'll peak out when the order inflow is at its peak.
Okay. So I also wanted to pull your this conversation a little further to understand widely about the entire PSU gamut, to help us and our viewers really understand which part of PSUs can one still really look at beyond defense now, and which part is just absolutely frothy and overheated and exuberant and where you would want to stay away from.
So, see, PSUs largely operate into core sectors, and so at one go you have all the banking names like State Bank and all that. And they benefited because of the actions taken to clean up the balance sheet by RBI, and they pushed banks to recognize. So when the actual rally started, these companies had very healthy balance sheet, and they were starting to grow their loan book, and they performed better, and they were trading at half or even lower valuation than private sector banks. So it was a sitting duck for investors initially. So the other pack which has really moved up is the power sector, which is basically you can combine power grid, NTPC, RECs, and PSCs of the world. That again, that sector went through a lot of upheaval, a lot of NPAs were created, and the capacity addition was coming to very little. Actually, private participation was limited to largely renewable sector, energy capacity expansion. So these sectors came back with a vengeance because demand was growing, and suddenly you saw that there were deficits in India, and which is continuing till now. So so power was the second sector within PSUs which has done well, and the third is defense, which we just discussed. So I would say that largely there is some fundamental basis to this rally. Uh, Question is whether these PSUs have actually, reformed themselves and become the most efficient, and they can deliver the same ROE or ROC like the private sector. That I still doubt. But obviously, this government has been more proactive, and they have pushed them to deliver on, their volume, etc. And so that way, I think largely the rally is justified. There are few cases here and there where it is difficult to justify those kind of valuation because some of these stocks are highly illiquid, and some market participants have taken that opportunity to push up those stocks. So wherever I would say shareholding of or the free float is very low and stocks are up, I think investors need to take cognizance of that and stay away from those names.
Okay. Within the mid and the small cap space, sir, where are you still looking at for value despite the recent run up?
It's very difficult in terms of small cap and mid cap to look at sector wise. It's best to do bottoms up research.
Yes.
And so we continue to look for opportunities bottom up. Meaning, I would say that the themes which we really like are recycling theme, that we also like the renewable theme. So these are some of the themes that we like. Then also we're looking for some consolidation in certain sectors like cement, etc. So these are the themes where we are, trying to position ourselves in a small and mid cap.
Fair point. I think your answer itself is my next question. For a research-oriented person, there is no better low-hanging fruit than to find out potential acquisition targets in a sector that has been long ignored. Cement, for example, we've seen two transactions in the last month or so, one by Ambuja, the other by Ultratech. Yet, सीमेंट कंटिन्यूज टू बी इन दैट जोन कि भाई ठीक है, कोई कैसे खास ओवर वैल्यूएशन तो खैर बिल्कुल ही नहीं है. देर इज़ नो इंटरेस्ट एंड it's been ignored for quite a long time in this rally. Now, when you look at these acquisition targets, what could possibly 2 or 3 be?
So, Shandaji, meaning everything has to be seen in context. And from acquisition point of view, one needs to see, two, three things. One is whether the acquirer is better creating a greenfield project, or is it better buying them? So the cost of a greenfield project comes to around $80 to $85 per ton.
Okay.
And so if the assets are available around that price, or below that, then it makes it's attractive for the acquirer to acquire them. So my view has been that company, all these deals which are happening would be happening around $80 to $85 per ton, plus minus $5 to $10 here and there, depending on the quality of assets, etc. And the biggest reason is that the acquirers are large companies with their own brands which command significant premium. So they are not going to pay any premium for the smaller company brands, because in any case they're going to get out of those brands. They will
Yes.
yeah. So I don't think they will pay anything more than the replacement cost, which is around $80 to $85. So for investors, they have to see companies, one which are in the news, probably in the bus, to sell out and are available at less than $80 to $85. Those are the companies which investors can target.
Fair point. So don't look at the If it's a branded kind of a product, don't get into that as an acquisitive target, but just look at non-branded cement companies. Well, I think that's a very fair assumption to make. Without taking names, you've sort of eliminated many which could be potentially good targets to buy, but nevertheless, $80 to $85 per ton is something which is the replacement cost. Fair. That's a very good metric. The other part, Rakesh ji, is this pharma space and the chemical space which is making a comeback, especially chemicals. Exports are picking up, although there is unabated dumping from China which continues. Some sanity in prices as far as the retail market is concerned. This overall chemical space, how do you see it as a research oriented person, and where is value to be had in this beaten down sector?
So chemical is definitely looking very attractive from a valuation point of view, because the sector has underperformed in the last 1.5 years because of the reasons you mentioned. And there are signs that things are reversing a little bit. Will they fully reverse or not? Only time will tell us. But since valuations are attractive and market is in such a mood that if they sense anything which is going to happen 6 months later, they would already, I think, re-rate it. So I think chemical is definitely one of the sectors where there is value and where investors should focus on. Coming to what will really work, I think one has to look at companies who have done decent margin even in the downturn in last 1 year. So if the companies have done decent margin even in the last 1 year when it was a very difficult period, those are the companies which will do very well and should get re-rated. So if the company was loss making in the last 1 year or has margins erode quite significantly, I think we should stay away from them for some time, because that would those stocks would rally in the second part of the sector re-rating. Initially, good quality companies would rally, and maybe once they have rallied 50-100%, investors can look to shift into the second level, where these high beta names might start to come up.
Okay, Rakesh ji, 50 to 100% in what kind of a time frame? I am just asking this because in normal old days 100% rise was maybe long term 3 साल 3.5 साल. आजकल तो आपको बेहतर पता है हमसे.
That is true. मतलब अभी if you tell anybody that you can generate 20% return, they'll say, "Bus, I can do better than you." So things have changed. But see, this is what we are talking about is commodities. In commodities, they go down 70%, they come up 50-100%, and it happens in pretty short period of time. So I would say that if the re-rating has to happen for chemical sector, if people do believe that the green shoots that we are seeing is actually a reversal, then this should happen in next few months only, not like a 2-3 year target. But as I was mentioning initially, let's stick to high quality companies, and then probably later on, if there are more evidence that this sector is reviving, we can shift to higher beta names.
Okay. Sir, also wanted to understand from you, there is this underneath a lot of fear lurking, just like how Shell began the show with, that, probably a lot has really happened. We've seen a dream run of sorts. So there is this impending fear that there could be a correction. What exactly do you think could upset this bull market and the trend that we are seeing?
It's difficult to say. Market has been digesting any kind of bad news also pretty easily. When I start to think, one of the basis of this market rally was, fiscal consolidation that we saw from the government. And if things are going to turn a little bit more populistic in this budget, maybe that would really, create a little bit of, ceiling for the stocks. Because then the growth rate might shift and there could be a sector rotation that we were discussing. So at the moment, I think budget is very crucial, and to see whether this government is going to follow the path of fiscal consolidation the way they were doing it in last two stints. That is, I think, that is one of the key risk factors which is there. Number two is that a lot has been done on inflation globally, but it's still not abating that much. If the inflation was to come back with a little bit of vengeance, maybe things might turn negative for the market. So these are the two things I think one needs to watch out for. I think the fiscal consolidation in domestically and inflation globally.
Rakesh ji, in terms of managing your own money, what is new that you've done? How much, if at all, have you moved into cash? How much profit have you booked, if at all? And are you looking to redeploy at current valuations? What is your thought process?
So, Shailendraji, fortunately, we have been fully invested, and
Okay.
while we did, take out a little bit pre-election, I would say 5-7%. Uh, but fortunately, the market fell so much that we had an opportunity to reinvest that
Ji.
Okay.
uh, pre-election only. So we didn't really have to wait post-election. And see, never in our wildest dream we thought that NDA is not coming to power. So that was the base case always. So I would say that in this market, it is very difficult to remain on cash and outperform.
True.
One has to remain invested. But let's assume that we'll be able to get out only, after a 5-10% fall, if the market were to peak out. So always assume that your net worth is 10% lower than where it is right now.
Wonderful. And if I may just probe a little bit more, whatever you booked profit into, and when this lovely opportunity came on the counting day, did you buy the same stocks or did you sort of expand your universe of purchases?
So, Sharanji, obviously, we have been, trying to get into themes where we think, there is going to be multi-year growth stories. So, the themes that I was mentioning, recycling is where I got into, and then renewable theme we've been trying to play through different angles. One is directly to play with the power companies, but then there are a lot of ancillary companies and sectors which benefit out of that. So those are the sub-sectors that we targeted in our investment. So yes, and some shift to chemical and pharma. So that also will help.
Okay. So, with the respect to the upcoming earnings, where do you see the outperformance can lie and the underperformance will come in from the upcoming Q2 earnings, sir? Q1 earnings.
Yes. So see, I think QOQ there would be a little bit of dip because we had a massive heat wave and also the elections. So a lot of things came to a standstill. So Q1 earnings are going to be a little bit muted. That's what I feel. And sectors which are more cyclical would do slightly worse off because they are more impacted by these gyrations. So I would think that banks and the utilities and those guys will continue to do well, whereas cyclical sectors like cement, metal, etc., even the basic other building materials, etc., would do slightly worse off than last quarter.
Fair point. Rakesh ji, before we let you go, one of the largest and the most attractive lightning rods on the top of the Bombay Stock Exchange building is Nifty kaha jayega. 24,000 we have seen in June. We also saw 21,000, 22,000, 23,000 and 24,000 in one single month, probably 12 trading sessions. Now, light us the path for say 1.5, 2 years as far as Nifty is concerned.
So let's see, we are expecting earnings growth of around 14-15%.
Okay.
And assuming there's nothing to derate, and of that, we have already seen like 5-7% rally. So for this year, I would say there's another 4-5% left for this year, assuming there's no derating. Overall, I expect market to grow by 13-14% CAGR for the next 12-18 months. So yes, probably I think we should do 22,800 by this Diwali or by December.
Sir, 24,800.
24,800 I was mentioning. We already
Yes.
moved a lot. So from here, we need to see earnings to really support the market rallying up.
Absolutely, and we are in the month of July. Earnings will be upon us like a cascade of rains that's all over North India over the last 1 or 2 days. Rakeshji, thank you so much. And before we let you go, because you are such a value creator for not only your clients but also for shareholders at large, can you please name the 3 clients that you've added most recently in the small cap and the mid cap space?
So, Chandra, our latest additions have been, one is Dave Plastic. They manufacture polymer for transmission lines, and they are doing high valued stuff. So they're doing high kV lines like 64 kVA. And as you know that every country is trying to shift towards green energy sources, and the requirement for transmission lines is huge. So Day Plastic actually is one of the world leaders and benefits out of that. So that is one of the companies we have added. We have also added a company called Associated Alcohol. They are in process of launching a very high quality Indian made foreign liquor. They have their own brands. So that, and they're backward integrated into ENA and also ethanol capacity. So it's a fully integrated business model. So these are the 2 main clients that we have recently had.
Thank you so much, Rakeshji. It's always, such a pleasure to hear a calm voice in this kind of a chaotic and booming market. It was a pleasure listening to you, sir. And we wish you all the best in creating supernormal wealth, not only for yourself, but for all your clients. And we look forward to having you again soonest possible. Thank you for your time.
Thank you, sir.
Thank you. Thank you. Okay.
Okay. That, ladies and gentlemen, was Mr. Rakesh Arora, our guest on Market Guru, a gentleman who's created a lot of wealth for his clients as also for the shareholders of those clients. And his 2 additions are Dev Plastics, I still can't get over this name, and Associated Alcohol. This I like. So we'll keep on track on both these companies, and for the moment, please allow Sakshi and me to bid you goodbye on Markets Guru. But we'll be joining you shortly at 2:30.
With that wrap up, thank you so much, viewers, for tuning in. But we'll be back very shortly.
Amar, the other space that is buzzing very well in the market these days is cement counters, primarily by 2 major